A very good afternoon. You're watching the newsroom right here on ET Now. I'm Ajay Sharma. The banks are doing bulk of the heavy lifting today. IT is coming under pressure after the street was not really impressed by the performance of TCS today. Reliance is also trying to stage some amount of comeback. But net, we are still managing to hold bulk of the gains made last week. And a large reason for that stability is because macros have seemed to have stabilized quite a lot. So we thought of getting you a chat around markets and macros with someone who understands this subject extremely well and is joining us today from London, all the way from London. Arnab Das is joining us. Arnab, thanks for your time. Good morning there in London. There is a lot of volatility in your own backyard on the political scene. But today we are going to speak about stability, which is coming on global macro front. The US 10-year has eased off, though dollar hasn't, but crude has eased off. And there is a general sense now that bulk of the disruption is behind us. Would you agree to that hypothesis?
Ex-Prime Minister heats up as...
I think we're still in a volatile environment. The war continues. The sanctions front will probably continue to be complicated, and I don't think we can rule out the possibility that Russia further restricts the supply of energy to the world and to Europe in particular. It is true that a number of commodity prices have come off their highs, but I would suggest energy in particular is significantly higher than it would otherwise be. Given that China is still growing very slowly amid, sort of on and off lockdowns, given the risk of this Russian oil cap that the U.S. and G7 are discussing, and the challenges in the gas front, where Russia, I think, is clearly signaling that it may not provide a full supply of gas to Europe going into this winter, several months down the line, but it's already a signal that's taking place in high summer, right? So I think there's still a lot of volatility to come from that side, from the war and the pandemic, even before we get to the challenges of growth and inflation, particularly in the U.S. and many other parts of the West. So I think we're still in for a bit of a rocky road. I think things are going to be quite different from one country to the next, both because of the energy and commodity shock and because of the late stages of the pandemic. Hopefully it's late stages. So I don't think we should be comfortable about a period of low volatility. It'd be great if it does materialize, but I wouldn't bank on it.
Right. Arnab, one of the big monitorables this week for global money managers and allocators would be the US CPI, which will be out on Wednesday. Is there a case to believe that perhaps that's peaking out, because almost all commodities have come down pretty sharply, be it crude, industrial commodities, even global agri commodities have come down. Will that be captured in this reading, or not this one, but the subsequent one?
I think, there'll be some effect, right? As you say, commodity prices have come down from their highs, and that decline in commodities has been going on for a little while. So some of the effect should be in the headline CPI. I think, the challenge here is that even as headline CPI starts to come down, there's still upward pressures in the case of the US, especially, but not just the US, on core and on PCE, right? I mean, on Friday, we had a very much stronger than expected payrolls number, which suggests the labor market remains quite tight, right? The unemployment rate has been stable for quite some time, for a couple of quarters now. So therefore, even if we get a kind of technical recession in the sense that GDP numbers are smaller in Q2 as they were in Q1 year on year, it doesn't mean that we're really in the kind of thing that we would call a recession, or that the NBER in the US would actually formally classify as a recession. It may feel like still quite a strong, robust economy. So I think the key thing is that even if headline inflation starts to moderate or continues to moderate, I describe it as it's sort of high. It's not really accelerating very much. Maybe it's peaking out, but it remains elevated, and it continues to bleed through, pass through into core. Then we're still looking at a decelerating economy in which the Fed is probably going to continue to tighten, and probably in a relatively strong way. Meaning, i.e., 75 basis points to come, maybe not just once, but maybe twice.
Right. Arnab, in fact, over the weekend, commentary was coming in even from our own central bank head, RBI Governor Shaktikanta Das, that October is when he expects prices to cool off meaningfully, and he would be meeting a clutch of foreign institutional investors in Singapore this week to tell us how they are tackling the soft landing, etc. But I would like to ask you that now there is a lot of social unrest in several economies across the world. And there are certain, even political leaders are coming under pressure on how they are handling this unprecedented time. There is a midterm election in US in November. And Mr. Biden's position or loss of political capital is something which a lot of people are discussing. So do you see a case that, they continue pressing the accelerator on bringing down in a sledgehammer kind of approach, even if it is at the cost of impacting growth quite a lot, because it's their own issue now?
Yeah, look, I think it's pretty clear that that President Biden will face quite a shellacking in the midterms along with the Democrats. I think the front burner issue there is the root cause of the instability and social unrest that you mentioned, which is very high inflation. Inflation, of course, is a regressive kind of tax. It hurts those on smaller incomes, spend a larger proportion of the household budget on food and energy than people who are better off. So, of course, that is going to be a major problem in the U.S. and in many other countries, and it's going to continue to show up. I fear, in the politics, whether that's the electoral politics in the West or social stability in many other parts of the world. I don't think there's very much that governments can really do about this other than to tighten belts through central banks tightening monetary policy, as we've been discussing vis-a-vis the Fed, the RBI, and many others, or maybe there's a way within fiscal policy to cut back, to lean against the wind, and do some sort of targeted relief to households that are most directly hit by energy and food costs, especially if there are further disruptions coming from the war or from the sanctions and kind of retaliation by Russia. Unfortunately, I think what we're looking at is more general tax relief so far, and more general measures rather than targeted measures, which are likely to maintain inflationary pressure for a while, and also suggest that monetary policy would have to be tighter than otherwise, right? So that's not an ideal cocktail for the economy or an ideal cocktail for the markets, even if it's what's achievable politically. So again, another reason I think that I don't think we're going to have a very severe problem in most of the world, but we are going to have some adjustment problems in many parts of the world. And that, I think, is still continuing to play out through the markets. And hence this view that we'll still be in a volatile time and that there's real value to being sort of diversified by country rather than having, and by sector, rather than having all of one's eggs in one basket. Because, the inflation process is going to continue, but so is the tightening by the Fed and others. And eventually inflation is going to come down, possibly quite strongly.
Arnab, what is the probability would you assign that in the next 4 to 6 quarters, the growth actually may get so depressed that central bankers may have to go back on some sort of QE once again? Because that is also one of the hypotheses which some of the strategists are not ruling out completely.
Right. I don't think it's the central scenario for the next few quarters. Like I say, I think in the next few quarters, we still have to deal with the aftermath of the pandemic, the ongoing war and sanctions, and the challenges there. And so I think, if anything, we're in a kind of slowing growth, maybe in the case of Europe, a threat of recession kind of environment with still very high inflation, maybe not accelerating, but still elevated inflation. So that's not an environment in which rates are likely to be cut. They're more likely to be increased. It's not an environment in which balance sheets of central banks are likely to start rising again. If anything, they're going to continue to be reduced because the inflationary pressures have to be squeezed out of the system now that they're spilling from headline into core and affecting inflation expectations, particularly in the US, UK, and even indeed in Western Europe to some degree. So I don't think we're looking at that in the short term or in the kind of cyclical horizon. Longer term, I do agree that there is a big growth challenge and that we are possibly going to see a significant change in the relationship between growth and inflation, maybe in a structural way. Potential growth might be lower than otherwise because some of the barriers to investment and trade around the world have been raised, and they're probably going to stay higher. If Russia and the West are going to continue to decouple when it comes to energy and other commodities, well, that implies a segmentation of otherwise globally traded, actively globalized commodity markets. It implies that Asia might get some benefit, but Europe might suffer something, and the U.S. might be, somewhere in the middle because it's essentially energy and commodity matched in overall terms, right? So again, there's a reason to think that there are going to be different things going on different major economic regions and economies in the world. And that, I think, does point to lower growth and probably points to a cap on how high central bank rates are going to go and puts a floor on how small their balance sheets are going to be. And I think, sort of over the long horizon, we're probably still in a low interest rate world, just that right now we're in one of those phases where rates are going to continue to have to rise for, I say, at least several quarters.
All right, Arnab, we'll let you go on that one. Thanks so much for helping us understand some of those issues which are still on the top of the mind of most of the investors around the world.